Hey guys, Toby Mathis here, and today I'm going to talk about the steps required to set up your trading business. So I'm just going to jump right on in. First off, if you don't know what a trader is, let's just talk about stock trading in general. If you're somebody who's trading in the stock market, there is no code provision that says you are a trader and you're able to take business deductions against your income and creating losses and things like that. There's nothing in the code that talks about it. You have to go to a publication and you have to go to court cases. And they're going to say what a trader actually is. But before we get there, I'm going to break this down. What a trader is someone whose level of activity in the stock market rises to the level of a trader business and allows you to do what's called a Section 162 expense. Otherwise, you're limited to investment expenses. And what a 162 expense is ordinary and necessary business expenses. So things like your computer, your cell phone, data feeds, traveling, going and meeting clubs, and learning about trading, those are all expenses that would be deductible under here, but they are not deductible if you are an investor. So that led the IRS to start contesting these cases. People were writing off their expenses on Schedule C, and they would have a negative amount. So they would always have losses because there's no trader business income. The income would be picked up on their Schedule D. So I should say this is really their expense. So they're grabbing their expense on Schedule C. Their Schedule D is where they're showing their income. What could go wrong, right? You're basically saying, please audit the heck out of me. Because when you see a Schedule C that has nothing but loss on it year after year, you have something called the hobby loss rule that gets triggered, where the IRS almost always is going to scrutinize it. And that's what I've seen. I've been doing this for 27 years, and this has been an issue for as long as I've been practicing. And I just notice over and over again that these folks are just putting a bullseye right on their back, and they get nuked because they end up going to a court. And we used to have a joke, what do you call an attorney with an IQ over 70? Your Honor, right? You're going to a tax court. I'm just joking. I'm an attorney. I can make fun of my own kind. But the whole idea is we don't want to have to go to a tax court where they start doing this. Is it a regular activity? Is it extensive? Is it substantial enough? And that's really what they're measuring. They're looking at, are you in and out of the market on a daily basis? And what we come up with is that there are hard rules if you're a trader, and then I'll show you the exception to get around this. There are hard rules as to whether you're going to qualify. And I'm just going to write it up there and say 800 trades a year. They're under 30 days. It's substantial. You got to have over $50,000. And you got to be trading on at least 75% of the trade days, which is right around 100, what is that? Probably 180 days, right? IRS and the tax court has kind of given us these as our basis that we can use as kind of our safe rule. Now, I'm going to throw one other in there, what I see coming up, which is if you have a W-2 job, you're going to have a lot of trouble. So here's this in a nutshell. Trader is not defined in the tax code. It's not like you can sit here and say, if I do this, I'm entitled to these deductions. What they say is, I can give you some golden rules that seems like you're going to have a recipe for success. But it seems really risky. Your audit rate, we already know for sole proprietors, is about 800% more than its brethren, S Corps, C Corps. It's significantly higher than just a regular taxpayer. So I'm not really excited about having you classify yourself as a sole proprietor for expense purposes and to be a trader for your activity purposes. It just seems to be a recipe for audit and decimation. So I want to avoid that if at all humanly possible. So what's our option? Well, we know what a trader is. And by the way, I'm just going to put a caveat because some of you guys may qualify as a trader. And then you're saying, what happens to my losses? Your losses are still capital losses if they're on Schedule D. The one way you can make your losses into ordinary, and by the way, if you have capital losses, they only offset capital gain with one exception. You can write off $3,000 a year against your other income. So your W-2 income, I'm making $100,000 a year. I lose $10,000 in the stock market. I can only write off $3,000 of it against my $100,000. And I do that for 3 years. Going into the 4th year, I get that extra $1,000, right? So if I have $10,000 of loss, it's going to take me 4 years to write it off. That's why the stock market and capital losses can be mind-numbingly unfair. You have 1 year where you make a bunch of money and the next year you lose it. So I made $100,000 as a trader 1 year. I lose $100,000 the next year. The $100,000 is ordinary income because I'm trading short term. So it's going to be ordinary income taxed at my highest levels of my bracket. So I could be at 37%. The next year I lose $100,000. I don't get a $100,000 loss unless I make a mark-to-market election. So I'm just going to throw that down here. And I have to make it the year prior, timely election. Then I can treat my losses as ordinary loss and offset my other income. But again, I don't like that mark-to-market. I've seen people get burned multiple times on mark-to-market. It's treated as though you're liquidating your account on December 31st. But a lot of times we have a run-up at the end of the year. And if you're sitting there holding a position, and for tax purposes, it's treated as though you sold it. Even if you only held it for 20 days, if you cross that magic December 31st to January 1st timeline, boom, those gains are locked in, even if it drops in the following weeks. And I've seen that happen on more than one occasion. I saw it happen in a big way for folks. I still remember this. Qualcomm ran up crazy at the end of the year. I think it was in 1999. And you had people that were, even when they sold it, it wouldn't cover the tax bill. They had mark-to-market elections. And I didn't like that. I just looked and said, you have an artificial rule, not a big fan. So they're trying to get that ordinary loss. Here's a hint. If you're losing money in the stock market, try a different profession, right? It's not good. Don't lose large amounts of money in the market. If it's capital, then at least you have capital gain that you're going to be able to offset. And if you do it long enough and you actually invest and you're doing trading, you'll be able to offset your capital gains from those investments with the losses that you're generating on a short-term or a long-term basis. Like, you'll be able to use those capital losses, period, going forward. What I don't like is folks that are just stock day traders. Just statistically, it's not good for you folks. There's those of you guys who defy the averages, which is about 95% lose money, depending on which study you look at. And so there's always that 5% that's killing it, and they're saying that's the exception, not the rule. What we see is, my experience is about 80% of legitimate, like people that are really trying and spending a lot of time and energy and effort at it, about 80% lose money still when they're trying to be a day trader. That's just my experience. So, take it for what it's worth. One guy's idea. So here's how we avoid it. What we're going to do is we're going to go over here and we are going to use entities. And what we're going to do is we're going to actually structure very deliberately a family office that incorporates using trading as a business. And what we do is we create a business that's a management company. This is almost always going to be taxed as a C Corp. And I'm just going to pause right there. It's taxed as a C Corp. It doesn't mean it has to be a C Corp. It could be an LLC. So this could actually be, for example, if you follow our channel and you know that we like Wyoming, this could actually be a Wyoming LLC taxed as a C Corp. From a tax standpoint, it's a C Corp. And the reason we're doing that is because we want you to be an employee of it. We want you to be a director or an officer of that organization. And we want this to be your family office. It's not just for trading. This is for structuring your affairs from a estate planning standpoint, from a business standpoint, from a legacy standpoint. We want to create a central management company for your various activities. One of those activities is going to be your stocks. And we're going to set that up as an LLC as well, but it's going to be a partnership. So I'm going to put 1065. What you need to know is that means partnership. The corporation is going to be an owner, and you down here are going to be an owner. You're probably going to be, let's just say default, I'm just going to say 80%, and the corporation might be 20%. Why are we doing that? We're doing that because we want the corporation to be making money. We don't have to pay it a management fee. We can. We don't have to pay it guaranteed payments to partners, but we can. And what we really want is, hey, if we make $50,000, we want $10,000 of it to flow up into that corporation to then be able to be expensed at the corporate level for anything and everything that we can come up with. It might be running another business. You may have a side gig out here, for all I know. It could be managing a real estate LLC over here. Like, you're actually going to structure this to do other activities. But from a stock standpoint, we are not going to try to sit here and claim on our tax return that we are a trader. What we're going to let happen is we're going to get a K1 from this partnership return, and you're going to show your share of the capital gains, and that's all you're doing. Well, what about all my expenses? It's not your expenses. Corporation's going to incur all the expenses. Okay, well, how is it going to pay for it? It's an owner. Well, what if I have more expenses? What if I have other activities? Okay, it can make money in other ways. It can make money as a side gig. It could be doing other activities. It could be, whatever you do. It could be wholesaling if you're into real estate. It could be, doing a side business on the internet. You could be running a website. It could be managing your real estate and getting paid that way. And it could also be paid as a guaranteed payment to partner to manage your LLC. But what we aren't going to do is say, hey, I want to qualify my corporation as a trader. No, it's a management entity managing different LLCs for your portfolio. From a stock standpoint, this makes it pretty simple. It can still incur all those expenses, but it's not you. You're not incurring these expenses. You aren't going to sit here and try to qualify under here as a trader. Don't want that for you. Too much scrutiny. The courts are all over the place. There's cases where somebody traded $15 million a year, wasn't a trader. There's cases where somebody traded hundreds of trades a year and made money, but because they took 6 months off when the market was going nuts, or because they made so much money in a short period of time, the court said, oh, that's not regular activity. You don't get your expenses. Just dumb, right? It just defies logic. Don't do that, right? My advice to you is do this instead. And even if you qualify as a trader and you would all day long, I'd still say this because the audit rates are significantly lower and we do tens of thousands of returns. I've been doing this for 27 years and I could count on probably both my hands how many times we've seen audits come up on partnerships or S Corps or C Corps. It's almost never. It's very, very rare. I think they have a 0.01% chance. It's a fraction of 1% that partnerships even get audited nowadays. It's really low. And even if we are, we have our ducks in a row because we are not sitting here trying to follow this. We're not going to play this game. We're not going to try to write off a bunch of personal expenses and put it on Schedule C. Instead, we're going to allow the expenses to be at the corporate level where they should be, where it is normal and it's pretty regular when you see a family office. Hey, they're running their expenses for operating their business. They got other businesses that they're doing in there. They're building up their investments, but it works so much cleaner from a stock trading standpoint. So what do you have to do? Well, I'm going to break it down for you. First off, you got to set up the entity structure. So you're setting up two entities, generally speaking. You're setting up an LLC that's going to be taxed as a partnership, and you're setting up an LLC that's going to be taxed as a corporation. So the next question is, where should I set that up? There's a lot of reasons of why you would set up the LLC in Wyoming, because nobody can see it and nobody can take it. So you have a high degree of asset protection. We're not just setting this up for tax. No, taxes is a benefit by having a management company, but it is managing entities. That's what we want its business to be. We want it to be a family office for you to manage your various entities from an asset protection standpoint, from a legacy standpoint, from a business standpoint, creating separation between you and your family from the investments is actually a good thing from an asset protection standpoint, from an estate planning standpoint, and from a business standpoint. It'll eventually be walking around on its own without you because it'll outlive you because these things don't die, and it'll be part of your estate, and hopefully it's part of your legacy plan. Hundreds of years from now, you may still have that management company going. You still have that LLC going. So when we set these up, we're looking at it through those lenses. We sometimes call it the four-legged stool. You're looking at it from an asset protection standpoint, a tax standpoint, a legacy or estate planning standpoint, and a business standpoint. We want it to be able to stand on its own. It might get separate credit. It might do other activities. It might do other businesses. It may employ other family members and do a lot of other things. And you create a family council that's looking over your wealth. Those are all good things that it can do, but you're setting the stage to allow those things to happen. So you have to decide, what are the entities? LLCs, probably 2 LLCs, probably Wyoming. The corporation could be in your home state. I'd still probably set it up as an LLC in the state of Wyoming and register it in your local jurisdiction if you're going to pay taxes out of it, if you're going to take payroll and do things like that. Otherwise, I might just leave it in Wyoming. It's interstate commerce when you're doing stock, so it's not a horrible thing just to leave it there. You're going to make sure that it's registered. You're going to make sure that it has its proper operating agreements that allows us to have what we need from a formality standpoint to back this up. The proper tax elections, it's going to make its proper tax elections with its SS4, which is called employer identification number. So we're going to have a partnership and a C corporation more likely than not from a tax standpoint. You're going to open up brokerage account inside that puppy. Some people are like, well, but my brokerage account might say that I'm a professional. Okay, if you run into weird issues where somebody's being an outlier and they say, oh, we think that this LLC is a business and that you're a broker, okay, then set it up as we'll set up what we do here is we just set up a personal property trust to hold the brokerage account and make the beneficiary the LLC. It's the same thing, but it makes them happier for some reason. Every now and again, it's like 1 out of 100 where we have to do that. But otherwise, you're just setting up the brokerage account and I do this myself, so I have multiple accounts in multiple institutions where I have an LLC, that same LLC, multiple institutions, multiple different types of investing accounts. So I know it could be done because I do it, and we've done this with tens of thousands of folks, so we know it could do it. So it's going to fall on deaf ears when somebody says, "Oh, you're in a brokerage account, this, that, or the other." I'm sorry, it's not how it works. If you're dealing with somebody who knows what they're doing, we make sure it gets done. So you open up the accounts, and then you're going to pay. Generally, you're going to reimburse yourself for expenses that you're incurring, but realistically, we want to get a credit card, maybe get an Amex in that company. And if you're doing data feeds and other things, start having them incurred by that C Corp. That's what we want. We want the C Corp to be incurring the expenses. If it was computers, if you bought it, you can reimburse yourself out of the corporation. How does it get its money? That 20%, or you're doing what's called a guaranteed payment to partner, and you're paying the corporation a set amount. It can't be based on profit. It has to be a set amount that you're saying, this is what I'm going to pay that corporation to be the manager and manage my portfolio. And it could be multiple entities that it's operating. But again, talk to folks like us because we'll show you exactly how to set it up. We'll make sure the paperwork is done appropriately so you can get a bunch of tax benefits. And you can get all the benefits from an asset protection standpoint, you get all the benefits from a business standpoint, and then most importantly, all of this is a nice capsule from an estate planning standpoint. If you have a living trust around this whole thing, and something happens to you, whether you're incapacitated, this keeps running, or you pass away, this keeps running. Now the living trust might say, here's how you distribute the monies that it generates. You could always do that, but this is a very, very easy vehicle from an estate planning standpoint to pass on. Works like a charm. Now, what are the tax benefits you get? I could write off things like an administrative office in my home, computers, cell phone, all those things. Over here, I'm having to track, and I'm having to say what portion is business use, which portion is personal. Don't have to do that over here because an accountable plan with the corporation has different rules than you as a sole proprietor. So I guess I'll leave it like this. Avoid that Schedule C. Avoid it. I get that some of you guys would actually qualify, but there are other reasons besides just tax that we're looking at here. From an asset protection standpoint, and you want to remove, these are low-lying assets that any plaintiff's attorney would love to garnish and would love to grab. If you're sitting over here, it's easy for them just to take them away from you. Car accident, kid gets in a car accident, you get into a fight with a neighbor, whatever, somebody makes false claims against you, or you run a business and you have discrimination or some sort of crazy suit. Those are the assets that they can take. Not so over here. So we like it from an assets protection standpoint. something happens to me and I'm over here and I have that account in my name, I'm probating it. May not be the most difficult probate in the whole world, but you could be looking at 6 months and a lot of pain and statutory fees. For example, in California, it's 8% right off the top, depending on the value of that account. That could be going to the attorney and to the personal representative. So we want to avoid that if humanly possible by using a structure and keeping yourself away from having to go through a court process. From a business standpoint, this guy can stand on its own, do other activities, and this is really critical. If you want to actually have perpetuating wealth and a legacy in your family, then it helps to have a board and you're bringing them on and they're learning how to run these things during your lifetime rather than just giving it to them when you're after you've passed. But there's a lot of different reasons why we're setting this up. From a tax standpoint, this one makes sense. Avoid this one, too much scrutiny, and basically it's not that great of a benefit anyway. You're not getting the most out of it. We want an accountable plan. There's a huge difference in the treatment of corporations from a accountable plan standpoint when you're an employee versus if you're trying to do this Schedule C, and what you're actually able to write off is quite often shocking when you realize, wait a second, I have to keep a call log and what I use my cell phone for, and I can only write off the business usage. Are you kidding me? Oh, we only need a sample. We only need 3 months. Yeah, everybody does that. Yeah, nobody does that. So they always lose. So 94 to 95% of sole proprietors lose their audits. That's been our experience. We try to avoid it like the plague. We always try to put people into a structure. You set this thing up. You have the expenses run through here. You quit doing things as an individual when you're talking about your trading, and instead do it through a structure. Works like a charm. Tons of benefits, and at the end of the day, then you get to keep more of your money because you're getting all the tax benefits that for some reason we still can't. Congress just hasn't taken it up. Maybe one day they will, and they'll say, hey, here's what you need to do to qualify as a trader. Until that day, I'm going to continue to do it this way. Guys, if this is beneficial to you, please like and subscribe. In the comment section, if you could tell me any other clarifying questions you have, or if you want to call me an idiot, you could do that too. But you could put in there other topics you want me to address. That'd be great. And if you know somebody who has been battling with what is a trader versus is there a better way, then by all means share this with them. And good luck and God bless.